I'm Wes Smuts with McGrath Estate Agents, and today we're chatting with Kyle Hawksford from Rock Loans. Welcome, Kyle.
Hello, Wes. How are you going today?
Good.
That's all.
I think it's such a competitive market. I think people would like to get a little bit more insight from the finance side of buying a property.
Definitely. Happy to help.
So let's start immediately. At the top, what is a pre-approval?
So, a pre-approval, when you're going to buy your home, a pre-approval basically qualifies you to get finance for the property. There is a difference between the concepts of a pre-approval and a conditional approval. So some places will tell you you're pre-approved, and that might be as simple as the computer saying you qualify for a housing loan. I like to use the term conditional approval when we're going through the process, meaning that the bank has looked at your personal situation, assessed you as an applicant, and has then issued a letter of approval stating that you can find a property, subject to conditions surrounding the property or the conditions that are added in.
Sure. Now, what can go wrong if I've got pre-approval and I've bought a house and it's at the same amount that I was pre-approved at?
So the things that can go wrong and to be aware of is if your situation changes between when you apply for a loan and when the house settles, the bank needs to be aware of those things, and that can affect your approval. So that's the first one to be aware of. So my suggestion to people is, taking a new job after you've just gotten a conditional approval is not a good idea. That can exclude you from the loan you've just applied for. Things like that. Another thing to be aware of is there can be issues that arise in valuations that you have to be aware of with properties and things like that. And your building and pest inspections, things like that. So general condition of the property is a good one. And be aware of the location you're buying. Some banks do restrict certain postcodes. So you need to be upfront with your bank or your broker about where are you looking to buy and discuss which postcodes may be excluded if you use certain banks.
So to be clear, if I get pre-approved for $500,000, I can make an offer on a property up to $500,000, but the valuation must meet that number.
Correct. If you make an offer on a property for $500,000, the property needs to be assessed itself. So the bank will usually use an independent valuer if they don't do their internal sort of valuation. They'll send someone to review the property, and that'll do a report up for the bank's purposes. Now, if that comes in at the $500,000 and the house looks okay, nothing major wrong, usually smooth sailing ahead. Yeah.
What are my options if the valuation is less than my offer?
So the first rule of thumb that I say when you come across this, because this can happen in a market that's changing, valuers are trying to find where the property you've chosen fits into the market. So sometimes it will come in low. That is sometimes a reflection of the individual property. It's sometimes just a reflection that there's no sales out there that they can find to support or the similar to your house that you've chosen. So what I'd usually suggest to do is open communication. So you're communicating with your solicitor, letting them know that this has happened. You're communicating with the agent. The valuation has come in low by this amount. This is where we're at. It needs to be open and honest because it's usually looking for a negotiation to find out a position. You then either can put in additional funds. If you believe the house is worth what you're paying and the market says it is, you can either put in additional funds up to that value, or you can enter a negotiation with the seller and see if they can meet somewhere in the middle or go through that process.
And if none of those things are available to me, I can pull out based on my finance clause?
If you can't proceed because the value drops or something changes or the bank says they can't give you the loan that you desire, you can be issued with a decline letter on that basis. Now, a decline letter allows you to provide your solicitor and basically utilise the finance clause that's in the contract. In most cases, this is 14 or 21 days, and as long as you are open with that communication in that time frame, you can usually get out of a contract quite easily with a finance.
So there's three options. You can either make up the difference if you believe that the property is worth it, negotiate with the seller, and if you can't reach an agreement, you can pull out based on your finance clause.
Absolutely.
Perfect. Now, big one. Why should I speak to a broker instead of the bank directly?
Alrighty. So, the main reason why you should speak to a broker instead of a bank directly, every bank is different. Like, if all banks had the same policies or the same lending criteria, we'd only need one bank. So every bank is different, and if you approach your first bank, as I call it, the bank that your mum and dad use that you've grown up with, they may say no to you on something that 100 other banks might say yes to you on. And so you're basically limiting your options. An example is some banks require you to be 6 months in your job role. Others will do it a day in your job role if you meet certain conditions. So that one little item there could exclude a lot of people from purchasing a home if they didn't research first. So a broker is basically, in my case in particular, a no-cost way of seeing what all the banks out there that we have access to will do, who will be the one that will approve you. That's our first step. We always see who's going to be the one that's most likely to give you the loan, and then beyond that, from the ones that will approve you, who is going to be the best product of those for your needs, whether that be lowest rate, offset accounts, all the different fun little features that you can have. Well, fun for me, but like, I enjoy that sort of side of it.
Structuring it.
Yeah, structuring it, because the worst thing that can possibly happen is that you end up with a loan that's not suitable for you and that's not going to provide you with the needs that you have.
Yes. There's one thing there that was going to be my next question, and what's the cost? And I think you've provided that already. So there's no cost to the applicant.
No cost to the applicant. The way a broker works in the home lending side especially is that a bank pays them a commission about a month after the loan settles. So there's no cost to the applicant. Now that commission is not charged to you in any way, so they can't like tag at the top of the loan or anything like that. So basically you pick a bank from the list of them, and we have to break it down to your needs and find which one aligns with what you want. A month later, they pay me a commission, and that's basically how it works.
That makes sense. Now, the other question is the deposit. There is obviously a different requirement for a primary residence versus an investment. Is that correct? There is, and it comes back to the individual banks as well. So, to give you an idea, there are a couple of lenders out there that will do a genuine 5% deposit for owner-occupied properties and then add the lender's mortgage insurance on top of the loan, meaning you don't have to come up with those funds yourself. There are a couple of banks that will actually go to 95% for investment as well. Very rare in the current market, but there are a couple doing that. Others will need at least 10% for investment. So it's just understanding, especially if you're going from owning a property to buy your next one, it's understanding the limits you can get out of your property when it turns into an investment, and then what you can purchase for to sort of make use of the most equity that you can. So I think what you're telling me is it really depends from person to person, an individual situation,
yes.
And it's really important to sit down and discuss that with
It is. That is one of the most important topics, is understanding deposits and understanding equity. So what it actually means to have a contribution towards a house, and what it means once you're in the property in terms of what flexibility you have going forward.
Yes, that makes sense. Now, two interrelated questions. First one is, how long before I want to purchase a house should I be speaking to a broker?
Alrighty. So my suggestion, and this is just based on how long conditional approvals last for, is 1 to 2 months before you get real keen on looking at houses. So a lot of people will look at the market for a little while and see what's out there. When you're starting to get interested and know that you want to do something in the next couple of months, see a broker. The reason why is if they do a conditional approval for you, that will be valid then for usually 90 days, giving you enough time to sort of locate a property and turn it to a full application.
And related to that is, what should I be doing in the months leading up to the application and buying a property to make sure my application is as appealing as possible to the banks?
Different lenders all have different sort of things that they look at, but some general rule of thumb to get you ready to purchase. Avoid small little retail debts like your afterpays and your zip pays if you can. A lot of banks don't. A lot of banks are still working on how to assess those items, and Afterpay is one of the ones that will show up on your account and can look a little bit not as good in the bank's perspective. Yes, another thing to be aware of is to budget. It's the most important thing, is have a budget, know what you need to spend on your day-to-day items, and put a bit of money aside where you can. Having your own savings is gold, especially if you're just getting into the market. But also, if you don't have savings and you are leveraging on other ways of getting into a property, it's still good to show the bank that you stick to a budget and you are putting some money away, even if it's a little bit.
Okay, that makes sense. Then There's another question that I think is quite important in our current market with the changing demand and the number of buyers we're getting at properties, and that's auction.
Yes.
Now, traditionally, auction hasn't been that popular in central Queensland as a method of purchasing the average family home. I think there is a lot of apprehension around whether I can buy with finance. Do you want to run me roughly by how it looks to bid at auction with finance approval?
So, when you're buying at auction, the traditional auction is an unconditional purchase when you sign on the day. Now, usually the only risk one of the risks associated with doing it with finance is that the finance approves you conditionally. So usually they'll approve the applicant and then say, now go find a property up to 500,000 or 400,000. There will be a value there. It's just understanding that means that you qualified for a loan, and that the property you select has to also qualify. So it's just acknowledging the risk, doing your research, researching the property, and then the most important part is to set a limit. So once you understand and believe you know what the property is worth in the market, set yourself a limit that you're going to bid to, and then stick to it. So if you say you're going to bid 400 for this house, 400,000 for this house, and the bids go above that, you've got to know when to step back and say, okay, I'm not getting this one. This one's not going to happen for me today. I'll have to look and see which other ones come up.
Sure.
Otherwise, you put yourself at a bit too much risk if you go beyond your position.
So I think it's what you're saying is get that approval,
Yes.
understand what it's based on,
Yes.
do a bit of homework and see what a property should be valued at, and don't exceed that number.
Correct. Understand the conditional approval, understand the risks for the property side, and that it's not a guaranteed approval on that property.
Perfect. And then last question, and this is the thing I think affecting everyone at the moment. Why are there so many extensions and delays on?
Yes. So you'll hear a lot of different reasons depending on who you talk to. The main reasons that we're coming across at the moment is there is a high demand. So that's the first thing. There's a high demand for mortgages in Australia. The industry is growing. So that causes delays. And different banks have different speeds as well. So some of the banks that I deal with, if I apply today, they'll give me an outcome tomorrow pending any outstanding items. So there's still ones like that. There's others that if I apply today, you will not hear back for 20 business days because they either don't have the staff to complete the processes they've got in a timely manner. A lot of them are going through absentees at the moment. This is a thing that we're experiencing that we haven't seen on this level in Australia before, is people contracting COVID and being out of work for a week at a time. And it's spreading like that. So there's not just one person gets it in the way. There might be a team of 10 people and 5 of them are off. So we're seeing something we haven't seen before at a time when the market is growing. Yes. So it's all about communication once again and patience, and also understanding the bank that you're applying with. So ask your broker or your bank, what are their current timeframes, and can you explain to me how long it will take to get an answer? And most banks will have that information available. It's called SLA, so Service Level Agreement. So SLAs, and that basically sets a bit of a standard for how long to expect an outcome. Sure. Now, if your situation is more complex, you may need more time. So self-employed people, people that are doing multiple loans at the same time, you've got to be aware that it's a bit more complex. It might need specialist assessors, and that can drag the process out a bit.
Now, lastly, the finance clause. It used to be a 14-day standard. Now we're putting in 21 days a lot of the times. Does putting in the longer clause make the process take longer, or?
It depends, once again, on the individual. So I would love to say that putting a 21-day clause in doesn't make the process longer, but it does depend on the bank and the individual. So a bit of pressure to get things done quickly is a good thing sometimes. But the 21 days is what some of the banks are taking. So it's a hard one to answer, but the best way to look at it is just because there's 21 days doesn't mean it's not urgent.
Yes.
And so it's really stating that you want to hear an outcome in the first 7 days. The 21's there as if something goes wrong. That's how you've got to look at a 21-day finance. So you still want to, as an applicant, get an answer in 14 days. Yeah.
Well, thank you very much for your time today,
all right.
Kyle. I
It's
think
been a
it's been
pleasure.
really helpful. I think it's a difficult market for both buyers and sellers to navigate, and it's great to get some insight.
Thank you.
Thank you for your time.
Thank you.